This is a very simple introductory tutorial on how you price commercial property. It starts with understanding what cap rates are. In the simplest of terms, the cap rate is a percentage used by real estate to estimate an investor's potential return on commercial property. Assuming in this scenario that you buy it entirely in cash, it is simply the property's yearly profit divided by its total price. Let's take a look at the formula. The formula is net operating income, or NOI, divided by the property's value or purchase price. So again, the cap rate is simply an estimated rate of return. You can think of it like a CD or at the bank, or the rate of return you might find on a U.S. Treasury. Well, arguably, it's a bit more complicated than that on multiple levels. But for sake of this tutorial, a bank has no risk, theoretically, but real estate does. So given real estate carries more risk, it requires a higher rate of return to compensate investors for that risk. Most of the time, investors use the 10-year U.S. Treasury as the baseline for riskless investment, and then carry a spread from that to what would be considered a fair rate of return on a piece of commercial property. Now, first, we'll look at the 10-year Treasury, and then we'll look at the cap rate spread historically. This is the rate of return on the U.S. 10-year Treasury over the last 60-plus years. Now, as you can see, as you would expect, it's been all over the board in regard to rate of return over the last 50 years. The point being is that if a cap rate floats on top of the 10-year Treasury, they too would have been up and down a lot over time. One important point to that equation is this. If a piece of commercial property has long-term leases that are fixed, its returns and commensurately the property's value will vary inversely to the present or today's interest rate environment. Let me explain. Let's say you have a property with a 10 cap rate, or in other words, it's paying you 10% every year. Let's say interest rates drop from 7% on U.S. Treasuries to, say, 5%, as they did between the early 1990s to 2015. Well, if you're getting a fixed 10% on your commercial property and interest rates are dropping, it simply makes your commercial property more attractive and more valuable. We call that cap rate compression. And if you own commercial property with long-term leases, that's great. Back before 2008 recession, all of us in the commercial space, kind of felt like rock stars with cap rate compression. We were feeling really smart. At least we did for a while. Now, having said that, the opposite is also true. If interest rates go up, your property's value will go down. So, to say it's important to understand what's going on in today's economy is an understatement. Next, we'll look at cap rate spreads historically. This is the cap rate spread historically. The solid gray shaded area is the historical spread between the 10-year Treasury and the average cap rates. Now, as you can see, that spread has varied a lot. The green line on the bottom is the 10-year Treasury, and the darker line just above that is the average cap rate over time. Now, the average cap rate spread between 1991 and 2019 was around 342 basis points. Now, having said that, the cap rate spread in the third quarter of 2025 was 172 basis points, or 1.72%. To fully appreciate and value a piece of commercial property, knowing the quality of the leases on one hand and assessing the associated costs of maintaining the property on the other is essentially what it's all about. If you need help buying or selling commercial property, feel free and reach out.